Good afternoon, everyone. Art Alvarez at MortgageWorks, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute. Again, my name is Art Alvarez, coming to you from the Palm Springs and greater Coachella Valley area. It's been a beautiful day out here today. Definitely into that fall weather. Those hot 100-plus degree days are way behind us now. So it's been an interesting week, of course, with the election results last week. The inflation numbers that came out this week, both yesterday and today. So we've got a fair amount to talk about in terms of what's going on with the financial markets and mortgage rates. You may not all think it's great news in terms of mortgage rates, but nonetheless, let's go ahead and get into that. We always like to try to start with giving an update on where rates are at by directing you to our rate grid on our website. We try to keep this updated daily, and there you can see where they are. We are, certainly well into the sixes, mid to high sixes with most programs. So the days of the 5% mortgage that we saw just 7-8 weeks ago seem to be behind us, at least for now. Conforming 30-year fixed rate loans are still decent in the sense that we can get you mid 6.5, 6 and 5/8 with a decent credit score and down payment. The buy downs are still hanging in there. You can get a 3-2-1 buy down with the first year rate in the 3s, a 2-1 buy down with the first year rate in the 4s. FHA, VA hanging on to the 5s barely, right there at 5 7/8 FHA, 5.99 for VA, and of course the 15-year loan at 5 7/8 as well, or 5 3/4, I should say, and of course jumbos in the mid 6s. So what's going on in that respect? Let's go ahead and talk a little bit about the bond market. There you can see the bond yield and that chart for the last 5 days. It's not the kind of trend we like to see, obviously. We want to see that more of a downhill ski slope type of a 5-day chart. Instead, we've got pretty flat early in the week, and it's been up later this week. And there's a few things going on in that regard. In fact, right now, the bond yield at 4.44 is right about where it shot up to last Wednesday, directly after the election results, the presidential election results. Then it actually settled down, rested last week, early this week. Now we're back up. So what's the culprit here? What's going on that's getting that 10-year bond yield trickling back up again? So there's a couple of things. This week was all about inflation numbers. Released this week, the first thing that was released, because Monday and Tuesday was pretty quiet. So we had the Consumer Price Index, or the CPI. It actually climbed a little bit, 0.2%. That was the 4th month in a row. Core CPI, that excludes food and energy, that also 0.3% for the 3rd month in a row, slightly elevated. And the yearly CPI did creep up from 2.6% from 2.4% in October. So it's kind of a good news, bad news. Inflation's not taking off again, but it's kind of trickled up a little bit. And of course, that yearly rate at 2.6, that's the first uptick in the year-over-year CPI in 7 months. So that's not entirely good news. And then today we had a similar situation with the Producer Price Index. That's the inflation number at a wholesale level. It was forecast to be at 0.2%. That did come in as forecast, but that's an increase from October when it was 0.1%. And then the core CPI, which I don't have on the slide here, again, the core PPI, again, excluding food and energy, that was actually up 0.3% from 0.1% in September. So even a little bit more of an uptick. So the bottom line is we're seeing a slight bump up in inflation. And that's, of course, not good news for the bond market. And as well, the language coming out of the Fed Chairman Powell is now on record as saying the Fed does not need to be in a hurry to lower rates further, given the strength of the economy, because the economy does appear to be maintaining strength pretty well. Now, the December 0.25% reduction in the Fed funds rate is still on the table. But now there's increasing discussion, increasing talk about, given the strong economic numbers, given that inflation, while better, is not entirely under control, it's not entirely at the 2% target, the Fed may take this as an opportunity to pause after the December cut by 0.25% if that happens. So you could see a pause in early 25 or maybe the first or second couple of, first couple of meetings with the Fed has in 2025, they may stand pat, at least subject to whatever the inflation numbers are that come out. And of course, the holidays are always a little bit of an issue in terms of, the shopping season and so forth. And of course, that's going to be looked at closely as a gauge as to how strong the economy is. The last remaining economic data point that'll come out for this week that could move the market or have an effect is U.S. retail sales. That comes out tomorrow. That's actually forecast to be down slightly, 0.3% from 0.4 in September. So depending on how the actual number comes out, if it hits that forecast, that could help us keep these bond yields, under control. If that ends up going higher, maybe if it's higher at 0.5 or 0.6%, then I don't know. You might want to watch out. We could end up seeing the 10-year bond yield crash that 4.5% level. Let's hope that doesn't happen. And by the way, in the background, there's been some talk about, we could see a 10-year bond yield approaching 5% within the next few months, or maybe within the next 6 months. Again, that wouldn't be great news for the mortgage market. So with that, we're going to go ahead, and Jeff's going to come back on here. We're going to have a little discussion about as you know, they call him the Oracle of Omaha, Warren Buffett, and his take on buying a home, because we've seen some interesting information in that regard that's somewhat conflicting. So we're going to talk about that right now. Hi, Jeff.
Yeah. Hey, how you doing, Art? Yeah, this is interesting. As I see you go through the numbers, it is one of those things. It's almost like the saying we say, brown shoe, black shoe. It depends on which side of the camp you're on. Is like you do this or you do this. So yeah. Warren had some stuff this week. Tell us what he said was almost, and then you did a little more digging, because that's the way you are. Yeah. One of them said to do this, and the other said to do this, which was conflicting.
Yeah, for the benefit of our viewers, earlier this week, Jeff alerted me to a recent article that came out just a couple of days ago, and it was on one of these financial news and media platforms called Benzinga. And the headline was that Warren Buffett telling young investors what should they do, buy stock or buy a home. And in the headline, it was buy a home, which of course you go, say what? Warren Buffett, the king of stock investing, he's telling young investors to buy a home. So I looked into that because I wanted to understand more about why he was making that suggestion, providing that advice. And of course, then what I found was back in May on the same financial news and media platform called Benzinga, there was another article about where the headline said that Warren Buffett says buying a home is a lousy investment. It's a lousy choice. So I really had to dig in a little bit to understand why we're seeing these conflicting headlines and conflicting advice from, again, the Oracle of Omaha, Warren Buffett. Well, a couple things about it. I think in this case, there's a little bit of truth to both the headlines in each article and the detail of each article. With respect to why Buffett might think it's a lousy investment, what he was really talking about there is a couple of things. One is pointing to the amount of investment you have to make from the capital you have available for down payment. And in the article, it makes reference to his own experience where he did buy a home way back in 1958, and he put 10% down. But he went on to say, well, but that took away some of my capital that I wanted to use for investing. So he, in a sense, portrayed that as a negative. One of the things that struck me about that, and I want to reinforce with our viewers, because it's still persistent, prevalent thinking today. You don't necessarily need to have a substantial down payment. Now, you have to have the income to support the monthly payment, yes, obviously. But the notion that you have to use up a lot of your capital, and in a lot of households, maybe all of your capital to buy a home, is not always necessarily true. There are a lot of mortgage options where you can get a home with 3 to 5% down payment, 10% or 15%, and that would allow you the ability to have some of that capital still set aside to do the kind of investing that Warren Buffett's famous for. The point of it is, you don't always, and in a lot of cases, many times, maybe a majority of times, you do not need 20% down to buy a home. That's sort of been established as the standard that I would argue and push back on, that it doesn't have to be that way. The other thing about the negative, Buffett saying it's a lousy choice to buy a home, is he points out that there's other costs associated with buying the home than just the mortgage. Well, obviously that's true. You've got property taxes, you've got insurance, you may have HOA dues depending on where the property is located. So it is true that the payment on the mortgage itself is not the full story. You have these other related, what we call property related expenses that you have to incur too. When you're paying rent, you pay your rent. You don't typically pay all these other, taxes, insurance, HOA dues, and so forth. That's already built into your rent. So he does point that out as, hey, something you need to realize, and why maybe it might not be as good of an investment because of that. And then the other thing about the article I thought was kind of interesting is that owning a home doesn't, and I wrote this down, does not guarantee significant financial returns like stocks do. I thought, well, wait a minute. I'm not sure stocks, you can argue, provides you a guaranteed significant financial return. The stock market can be pretty risky. Well, certainly owning a home, it's an asset, can be risky too. But if you're going to need a home or need a place to live for an extended period of time, 5 years, 10 years, etc., it probably isn't a bad idea to look into buying a home, despite Buffett claiming it's going to be a lousy investment. So that's my take on that part of the story that he has talked about. Now, what about the more recent article that Jeff alerted me to, where he says, hey, if you're a young investor, you should maybe buy a home rather than investing in stock, at least initially. Well, when you dig into that one, really what he was getting into was a couple of other factors that you should consider. One is, again, if you're looking for a place to live and it's going to be for an extended period of time, 5 to 10 years, he does suggest that buying a home may be a better option than just using your money to invest. And a part of that reason is the predictability and the financial stability that you establish by getting into home ownership. Because after all, when you do that, in most cases, what you're going to do is you're going to get a 30-year mortgage. Now, this is where I think Buffett's suggestion about to a young investor about buying a home really is what is the underlying premise. Is he thinks the 30-year mortgage is the greatest deal in the world. And I actually tend to agree. His point being is, if, when you can get a 30-year loan, of course, it's going to lower your monthly payment beyond a shorter term loan, like a 20 or 15-year loan, but it provides you predictability. It provides you stability in your cost of owning the home. Now, yeah, your property taxes are going to go up a little bit, insurance as well. We certainly know that in California last year or two. But compared to rent oftentimes goes up every year or goes up every couple of years. So you don't have the certainty of your housing related expense when you own the home versus when you're renting. And so when you combine, that alternative, or consider that alternative versus buying a home where you get, again, what Buffett calls that best program, best product in the world, that 30-year mortgage, that's where I think his advice about buying the home to a young investor actually is well supported, and I certainly definitely agree with.
Well, one of the things that I thought was very interesting that he pointed out was when he said in the article not to buy a home, it's better to save, to keep your costs down and then use that extra money for investing. They pointed out in that article, the only real estate he's ever owned, which is, again, boggles my mind to imagine that, is the home he lives in Omaha that he bought for $31,000. Do you recall how much that home is worth now?
Yeah, in fact, I want to say it's like somewhere approaching $1 million.
It's actually well over $1 million.
Right. And so, that's what's kind of interesting about, the negative Buffett article, we'll call it, from last May, where he's like, oh, it's a lousy investment, not as good as, the significant financial returns guaranteed by investing in stock. Well, by his own example, how could you argue that his investment for $31,000 in 1958 for his home has resulted in a current value that, yeah, you're right, it's well over $1 million. I think it's 1.2 or 1.3.
Yeah.
Well, pardon me, but I'm not going to say that I'm not going to say that that was a bad return. Now, it may not be as good as his stock portfolio, probably true, but one of the things in the more recent article where he talks about, yes, you should consider buying a home first before you invest as a young investor, is the fact that for most of us, common folks, owning that home will be your largest financial asset. And over time, generally, I would argue that home ownership is a relatively stable investment. Yes, we've had those periods like the Great Depression, 2008, those do occur. But guess what, folks? Anyone remember some of those 20% corrections in the stock market? So it's not like home ownership is unique in terms of periods where you're going to have these financial upheavals that's going to undermine the stability of your investment and cause a depreciation in the value of your investment, whether it's stock or housing. So I think you got to kind of keep that in perspective when you're considering either option. The other thing about the more positive article about buying a home first is he points out, if you have the money, is look at buying a distressed home. And if you're handy, fix it up and then maybe convert it to a rental. So then you're building additional financial assets over time, so that becomes part of your diversified portfolio. That of course eventually will be stocks, because that's really what he promotes. But why not have the real estate component of your overall investment portfolio? But I think really the biggest thing that where he's right about the 30-year mortgage is the idea of a one-way bet, the one-sided bet. Because if you look at various borrowing these days, interest rates for various types of borrowing, a 30-year mortgage is still an incredibly good deal. I mean, you can borrow money for 30 years in the mid sixes. Compare that to almost any other kind of borrowing. I mean, how can you argue that that's a ripoff or a bad deal? It really isn't. And what is so important about folks need to understand about the 30-year mortgage is that what does that one-way bet mean? Well, if you're going to buy a home and you've got the down payment money, the 30-year mortgage locks you in on a specific, identifiable, predicted rate of interest cost for a very, very long period of time. It's not going to get worse. Again, compare it to rent. If you're renting a home, over time, your rent's going to go up. It's going to go up maybe, again, once a year, maybe every couple of years. Once you get that 30-year loan in place, that rate is going to stay there. It's not going to change. And yet, why is it a one-way bet? Because if rates fall, as he would argue, is when rates fall, then you can pay it off. Or what most people can't just pay it off. They don't have the extra money laying around. So what's the other common way to take advantage of that one-way bet? You refinance the loan and to that lower rate. And then you kind of restart the clock. You got another 30 years at that lower rate. You've protected your upside a second time. So that's why a 30-year mortgage, he calls the greatest loan product there is. It's all about that one-way bet structure. It's basically a can't lose situation.
Well, Art, it reminds me of, or it makes me think of this. If you and I could go back, just say 10 years, and we were just getting started, and our electric company said, okay, you have an option here. You can lock in what you pay for electricity for the next 30 years.
Right.
I mean, it's a no-brainer, right?
Well,
Considering
exactly.
that I think we heard yesterday or this week that we heard that the Edison went up like 22%. It's going to go up another 6% next year. Well, if we could lock it in 10 years ago, it would be like we're paying, nothing for electricity. Well, the same thing holds true for, housing prices and the cost of ownership. When we can lock that in, like you said, it is a bet that you cannot lose on because you hold all the cards.
Exactly right. And part of the reason for that too is consider that home with that 30-year mortgage, in a lot of scenarios, in a lot of financial environment situations, it's an inflation hedge. If you got in fact, our recent period of time here, last 4 or 5 years, is a great example. I mean, imagine when if you bought a home in 20 or 21, yeah, the price of the home had gone up, but you were able to lock down for 30 years a 2.5%, a 3%, a 3.5% mortgage, and then inflation goes to 9%. Well, what did that do to your home value? It went up even more, and yet your interest cost was fixed at that 2 to 3% range. That is a great example of the inflation hedge benefit of, number one, home ownership, and number two, home ownership with a 30-year loan. And now the problem I think we have currently is the belief that, oh, that opportunity has been lost. These current mortgage rates, oh, they're terrible. They're not affordable. I can't possibly participate in this option, in this opportunity. Well, see, that's where I keep reinforcing the message that, first of all, rates are going to be around at these levels for a long period of time. The Fed is signaling that to us. And again, the Fed doesn't control mortgage rates directly. It's all about the bond market. Rates are going to be in place at these levels higher for longer. If you can't afford these current rates, which we can help you determine that, the idea here is go after that home ownership now. Use this 30-year mortgage that Warren Buffett thinks is so great. It is an inflation hedge. It's a one-way bet. Then layer into that a temporary buy down. So that what that does is it gives you that interest rate and payment relief for 2 to 3 years to then allow for general mortgage rates to eventually fall. So then you can exercise that benefit of the one-way bet and refinance into a lower note rate. And then you've got a new 30-year term at even lower rate. And what's going to happen when rates fall to give you that opportunity, that home value is going to go up from what it was when you bought the home. So it's really a win-win situation.
Well, I think it's something that, again, could be really confusing out there. And you added some clarity to this, because it is that thing. It's like, if you're taking, it's almost like your parents say, do this, and then you do this, and then immediately they tell you to do something totally the opposite. Right. I think it confuses the mind, and I think you cleared this up. The other thing I was curious about is this, and because I ask you this because you have over 4 decades of experience in this. Have you ever seen a market as unique as this, where you have a lot of people that are locked in at low rates, you have housing prices where they are, and you have pretty tight inventories that makes it a very unique cocktail? Have you ever seen times like this before?
Well, no. And the fundamental reason why, we've talked about this on the program before, 2020, 2021, the pandemic, that period, that was a 100-year pandemic. And what goes with that is essentially what I would call, we got to a level of 100-year interest rates. In 43 years, I never saw rates that low. And I started at the worst time when they were 17, 18%. But the point is, we never saw, in my time in this business, and if you go back and look historically, we never had 2 to 3% mortgages. And so the unique difference in this market since then is, with the inflation that got, driven up by, federal spending and all that, we've got this very unique situation where a majority of the housing stock is locked up because these homeowners simply refuse to give up, again, what Buffett calls the most important, the greatest mortgage program ever in the world, the 30-year mortgage. Well, if you got 30 years at 2.5%, you're going to grasp that thing tightly, and you're like not going to give it up until somebody gives you a compelling reason why you should. And that's what we're facing. And that's why inventory has been way below record levels. And of course, we thought that these higher rates would cause inventory to go up, because that's normally what happens. But the different feature of this market is those very low 2 and 3% rates. That's what has locked up what otherwise would normally have happened, just from basic economic principles.
Well, what's interesting, and I'll leave you with this, is even my wife and I, in our home, we were offered a very lucrative number for our home. And I because I didn't fall in love with my home, I love my home, but I didn't fall in love with that. I thought, that's a great deal. And she said one question that made all the difference in the world. She says, where are we going to go? And I think it goes right into what you said. We have a 2.5 or 2.75% interest rate. She said, where are we going to go to find a home that we like as much as we like ours at an interest rate that we can afford? And I think we're not the only ones asking that question.
Well, yeah, most homeowners are. And she was spot on with that analysis, because what she recognized is that you could sell your home at that top dollar. And one of the challenges is that home values have gone up since the pandemic. So at a particular price level, you're not going to maybe get as good of a home as you have now, because that home value went up from where it was 4 or 5 years ago. So if you did sell at that top price and you get all these proceeds, but then when you start looking around, you go, well, gee, for X amount of dollars, we're getting a home that is not even quite as good as what we have now, and yet it costs more than what we sold ours for. And plus, to boot, layer into that, we're going to go from 2 3/4 to 6.5. You put all those numbers together, and it's like, why would we do this? Yeah. So so ultimately, what that's suggesting is the current housing stock. These homeowners are thinking very rationally. They're thinking logically and rationally, and they're looking out for their best interest. And their best interest says stay put, and don't sell. And so, unfortunately, that's what's caused the lockup. But again, things are starting to change a little bit in that regard, which is why I keep talking about buy downs, because I think there's a little bit more of an opportunity than we've seen before, just based on the inventory that is starting to trickle up a little bit.
Well, speaking of buy downs, I'm going to let you go because that is next on the agenda. You've got another buy downs or the bomb slide ready to go.
I do. All right. Thanks, Jeff. Yes, everyone, as Jeff mentioned, I wanted to go ahead and cover buy downs again. I'm sorry to keep harping on this, but I cannot resist continuing to remind everybody why this is the best strategy to use in the current market. And a little bit of background. I was at a couple of local here in the desert real estate events, both with the California Desert Association of Realtors and the Greater Palm Springs Realtors the last couple of days. And some of the scuttlebutts, some of the discussion during those events was we are seeing some increase in inventory. In fact, in Palm Springs, the amount of inventory has crept up to about a 4-month supply based on the sale rate. So that's an indication to you, if you've been on the fence about buying a home, that we're starting to see enough change in the current conditions that buyers will have a little bit more leverage than they've had before. Now, a lot of my buy down discussions, all the examples I've been giving you, I've focused almost entirely on the 3-2-1 buy down. That's the most powerful buy down scenario that is available to a prospective home buyer. But I've gotten a little bit of feedback that, in some markets, it's not at a level, the inventory is not at a level where you expect that you can get enough seller concession to fully fund that 3-2-1 buy down, meaning there's some concession possibilities out there, but maybe not enough to cover that 3-2-1. So what I want to point out today is don't forget about the 2-1. The 2-1 buy down is a shorter period. It's 2 years instead of 3. You don't go as deep on that first year rate, but I still think it's a great option if you think there's a little bit of concession available and trying to make an offer at a home, but not quite enough to fund that 3-2-1. So this is why I think a 2-1 buy down can also be said to be the bomb. So let me give you the assumptions. I looked up a listing in Palm Desert, and in Palm Desert, the average purchase price of a home right now is about $700,000. So I found this listing, and it's a live listing. You can look it up. 4-bedroom home, 3.5 baths, 2,389 square feet on a 1/4 acre lot with a pool and spa. Been on the market for 45 days. So let's first look at what would your financing be if you're interested in that home. You're going to put 20% down to get that 30-year mortgage that Warren Buffett says is the greatest product out there. Well, with 20% down, your loan amount's going to be $560,000 at a current rate of 6.5. Your monthly principal and interest is $35.40. Now, if you think you're going to be able to get a concession out of the seller, as I say all the time, the most common sort of knee-jerk reaction in terms of a strategy is you submit an offer below list price, and you think in this case you can get away with $15,000 as your concession. So you're not going to offer $700,000, you're going to offer $685,000. Now, with 20% down, that does lower your loan amount from $560,000 to $548,000. Well, what does that do to your payment? That lower loan amount of $548,000 means your principal and interest is $34.63. Well, compare that to list price offer at 20% down. Yes, you're going to receive, or you're going to achieve, a $77 a month lower payment on the mortgage than if you offered full price. So is there some benefit there? There, of course. But again, it's only $77 a month. A lot of folks are kind of surprised that a $12,000 reduction in the loan amount only achieves that kind of monthly savings. But as I say often on the show, at current rate levels, every $1,000 borrowed is only about $6.5 a month in monthly payment. Well, if you do the math right there, that's what it works out to be. What I argue to do is, and I say this now more commonly, friends don't let friends offer below list price. What you want to do, if you see a home you like, and this actually, when I looked at this listing, this is a pretty nice home. If you're interested in this home, don't be tempted because you think there's some concession on the table that you can capture. Don't be tempted to just go below list price. Offer full price and get that concession in dollars from the seller, from their proceeds, so that you can apply that towards your financing. In this scenario, let me show you what that means. You submit an offer at the list price, $700,000. You ask for a $15,000 seller credit, and you're going to use that for a 2-1 buy down and closing costs. So your offer will be $700,000, your loan amount $560,000, just like our assumption at the top. But first year, your interest rate is going to not be 6.5% that you're paying on, but 4.5%. Your principal and interest is going to be $28.37. That's $703 a month lower than if you offered full price at market rate. The second year, your interest rate is going to be at 5.5%. Well, at 5.5%, your principal and interest payments $31.80 for the second year. That's $360 a month lower payment than a full price offer at market rate. Now, on a 2-1 buy down, the cost of the buy down is about $12,745. That means the buyer will then have $2,255 left over from that $15,000 seller concession to apply toward closing costs. So that way you're getting both a significant payment benefit the first 2 years, as well as getting some of your closing costs reduced, so their cash out of pocket to complete the purchase for down payment and closing costs is going to be lower because you still got that couple $1,000 to offset your closing costs. Again, this is a great example of why I think buy downs are the bomb. Friends should not let friends offer below list price. If you want to get a concession, get it in seller credit dollars. Let us show you how you can apply it to your loan for buy downs, closing costs, or both. It's a great way to get into home ownership where you have some affordable payments for the first 2 to 3 years. And then again, exercising that one-way bet, you're able to then, when mortgage rates do fall, you can refinance that mortgage note rate and get a new lower mortgage note rate, and then have that for another 30 years. Plus the fact, if you do that before the buy down period is over, you're able to still get those remaining buy down dollars. They're either applied towards your payoff when you refinance, or in some cases the lender will send you a check for the unused portion of the buy down money. So this is a way for us, for you as a home buyer, prospective home buyer, to do what we call marry the home and then date the interest rate. So keep that in mind. It's still an effective strategy to use today, because when those rates do finally start falling back into the 5s and hopefully into the 4s, if you buy a home now, you're going to see some appreciation of that home that's going to help you build wealth long term. So I hope you understand that particular scenario, that a 2-1 buy down is a good option if you don't think you can get enough concession from the seller to fund a 3-2-1. A 2-1 buy down can be a great alternative. With that, we're going to go to the closing question from last week. And here it is. We've been told to avoid an FHA loan for a home purchase because of the high cost of UPMIP or UFMIP. What is this and why does it cost so much? And actually, I think I do have a typo in there, so my apologies. Yeah, there it is, UFMIP. UFMIP is upfront mortgage insurance premium. This is charged on an FHA loan and is part of 2 components of mortgage insurance on FHA loans. There's an upfront piece, and then there's an annual piece. So the upfront piece, the annual piece, the other component of the mortgage insurance, the annual is going to range from 0.50 to 0.55% of the loan amount, and then that's paid monthly as part of your mortgage payment. Now, the upfront MIP is the part of this 2-tiered mortgage insurance approach that I'll get some pushback on from some borrowers. And the reason is it's perceived to be very expensive. The upfront MIP is 1.75% of your loan amount. So the way that works is, you know, you get into escrow on a particular purchase price. You're going to put 3.5% down. That's the minimum down payment for FHA. After applying that down payment, you're going to have remaining a base loan amount. The upfront MIP is then calculated at 1.75% of that base loan amount. And so, yes, it's going to be several $1,000s. You know, on a $500,000 loan, that's about close to $9,000. So, do you want to pay that out of pocket as part of your closing costs? Well, of course not. That almost never happens. Most folks don't have the money for that because, as it is, they're struggling just to come up with the down payment and other closing costs. So, what FHA allows you to do is finance that upfront MIP into your loan amount, and then you go therefore from a base loan amount to what we call your adjusted loan amount with the upfront MIP. So then what you're doing essentially is you're paying back that upfront MIP premium through your monthly principal and interest payment, because your adjusted loan amount is what's used for when the interest rate is applied to that to establish your monthly principal and interest. Now, a lot of folks will say, well, my gosh, this is really expensive. Well, not really when you kind of really dig into the numbers. If you take that 1.75% upfront MIP and add it to your base loan amount, what is that doing to your monthly payment? Well, it's going to increase it. But actually, when you take the annual mortgage insurance, let's say you use the 0.55, and then if you calculate what is the impact of the 1.75 lump sum premium to your monthly principal and interest payment, if you add those two together, that means the total mortgage insurance cost between both of these components is about 0.67% of your loan amount, you know, in total. Now, that is actually very reasonable. Here's why I say that. If you get a conventional loan and you're at a 660 credit score, your annual mortgage insurance, I can assure you, is going to be well above 0.67. It's probably going to be closer to 0.89, even maybe 1% or more. So FHA mortgage insurance, though deemed and perceived to be very expensive, in many, many scenarios is actually a better deal than private mortgage insurance. That 1.75, though, really throws people off. So I spend a lot of time always trying to show my FHA borrowers why this is actually a much better deal than you think it is. And I would argue the benefits of the upfront MIP far outweigh the cost, because with FHA, you're going to get a better interest rate across virtually all credit score levels, even if you're at 780 or 800. And even when you layer in the mortgage insurance cost. And again, FHA is much more kind to you as a borrower if you're at the lower credit score level. Keep in mind, the FHA loans, you can get one with 3.5% down with a 580 score, 10% down with a 500 score. So those are the kind of benefits that I think make the mortgage insurance premium, including this upfront premium, well worth the money. The other thing about FHA is it's much more lenient in underwriting guidelines, including allowing higher allowable debt to income ratios in most cases. So that's why I think overall this upfront MIP, it ain't as bad as you think. It's worthwhile. And if you need some help, I'm happy to show you in more detail how that works. So again, good question. It's something that I think you should embrace and not be fearful of. And with that, I'm going to go ahead and give you the closing question for next week. And I actually had this just come up last week, as I had a borrower call me with basically exactly this question on a loan that we closed almost a year ago. We purchased our home almost a year ago and set up an impound account for property taxes. We recently received a supplement property tax bill, and we're shocked to learn it won't be paid from our impound account that we had, and that we had to pay for it ourselves. Why is that? Very good question. We run into this quite often. We get a lot of calls on this, usually about a year after we close a purchase loan. So stay tuned for next week's Mortgage Minute, where we'll have the answers, and they're on the house. So that's it for our program today. I want to thank you for watching and listening to this week's Mortgage Minute. My name is Art Alvarez at MortgageWorks, where we have the answers and they're on the house. Have a great weekend, and we'll see you next week. So long. Take care.